Welcome back to Gold Rush Reporter, my friends. I'm your silver analyst, and today we're diving into one of the most important and most misunderstood topics in the precious metals world: silver price suppression and how the biggest players quietly use it to their advantage. Everyone keeps asking if silver is so valuable. Why hasn't it exploded yet? Well, the truth might surprise you, because the answer has less to do with supply and demand and everything to do with control. Before we get into it, I'd love to know what you think. Do you believe silver prices are being held down intentionally, or is it just normal market movement? Let me know your thoughts in the comments below. The world feels like it's spinning faster every day. New crises, new headlines, new chaos. It used to take a once-in-a-decade event to shake the global markets, but now it happens almost weekly. And in this constant storm of uncertainty, something strange has happened. People have become numb to fear. That might not sound important, but it's a huge deal for those of us paying attention to gold and silver. Precious metals have always been a safe haven when things get rough. When economies start wobbling, investors usually rush toward gold and silver for safety. But what happens when fear becomes normal? When people stop reacting to bad news because they've grown desensitized to it? That's the psychological trap many investors have fallen into today. Instead of looking deeper, they just see flat prices and assume silver isn't moving. But that's not true. The reality is that silver's real value is being hidden. Right now, 4 major banks hold massive concentrated short positions in the silver market, larger than any other commodity traded on the COMEX exchange. That's not a conspiracy. It's in the data, and this control allows them to suppress the price, keeping it lower than it should naturally be. Why would they do that? Because it gives them the perfect opportunity to quietly accumulate physical silver while the rest of the world ignores it. Think of it this way. While everyday investors stare at price charts, the biggest institutions are watching delivery reports and inventory levels. Those numbers tell a different story. Physical silver is being drained from major exchanges, ETFs, and London vaults. The smart money is taking advantage of the low prices to load up on physical metal. They push the paper price down to make silver look weak. And when everyone else turns away, they quietly buy the real thing. It's one of the oldest tricks in finance. Use fear and confusion to get what you want cheaply. So while mainstream articles claim silver isn't performing, the truth is that the biggest players are positioning themselves for what's coming next. Price becomes the greatest tool of misdirection, convincing people that silver has lost its shine while the most powerful investors in the world are betting heavily on its future. The deeper you look into the COMEX data, the clearer the picture becomes. It's not just coincidence, it's coordinated behavior. And that's where things start to get really interesting, because once you see how this system operates, you realize that price is not reality. Stay tuned, my friends, because in part 2, we'll dive deeper into exactly how this manipulation works and what the data tells us about where silver might be headed next. Now that we've set the stage, let's dig deeper into how the COMEX and big banks manage to control the silver market. Not by moving the metal itself, but through something most people never see: paper contracts. The COMEX, which stands for the Commodity Exchange, is where silver futures are traded. For every ounce of real silver sitting in a vault, there are often hundreds of paper contracts representing that same ounce. These contracts allow traders to bet on the future price of silver without ever touching the physical metal. On paper, that sounds like a normal part of financial markets, but in practice, it creates the perfect environment for manipulation. Here's how it works. Big financial institutions take large short positions, meaning they bet on the price of silver going down. They do this not because they think silver is worthless, but because they can influence the price itself. By flooding the market with paper silver, contracts that don't represent real physical supply, they artificially increase the available amount of silver being traded. This makes it look like there's plenty of silver out there, which pushes the price lower. It's a system built on illusion. The more paper silver they create, the weaker the price appears. Now, when the price drops, retail investors get scared and sell. That's exactly what the big players want. Once the panic selling begins, the banks quietly buy physical silver at those lower prices. And when it's time for contract delivery, when traders can actually request the real metal, most people just roll their contracts over instead of taking delivery. The banks know this. They count on it. Very few people ever ask for the actual silver, which means the game can keep going without anyone calling their bluff. But lately, cracks are starting to show. Physical inventories on the COMEX and in London have been falling steadily. Vault withdrawals are accelerating, and registered silver, the metal that's actually available for delivery, has dropped to some of the lowest levels we've seen in years. That means more people are finally demanding real silver instead of paper promises. And when that happens on a large scale, the system gets stressed. Because if too many people call for physical delivery, the COMEX simply doesn't have enough real silver to meet all those obligations. Think about what that means. The entire price structure of silver is built on leverage, on the assumption that people will keep trading paper rather than asking for the real thing. But once investors start to lose faith in that system, once they realize how little silver is actually backing all these contracts, that trust can collapse overnight. And when trust collapses, the paper price loses control. That's when physical silver finally starts to show its true value. This is exactly what the big banks fear. They know that once physical demand overwhelms the paper market, prices could skyrocket far beyond their control. That's why they use every trick available: sudden margin hikes, coordinated sell-offs, even negative press, to shake investors out before that moment comes. It's all about maintaining balance for as long as possible, keeping the illusion intact while they prepare behind the scenes. But this balancing act can't last forever. History shows that every manipulated market eventually breaks, whether it's currencies, housing, or precious metals. And silver's setup right now looks eerily similar to the early 2000s, right before gold broke free from its long-term suppression and started its decade-long bull run. The fundamentals are in place, the cracks are showing, and the pressure is building. When you start connecting the dots, you can see that the silver market is sitting on a time bomb. The cracks in the paper system are widening, and physical demand is quietly rising in places most people aren't paying attention to. Over the past few years, we've seen a steady outflow of physical silver from Western vaults into the hands of Eastern buyers, especially in countries like India and China. These regions have a long history of valuing hard assets, and they're now buying physical silver at record levels, while Western investors remain distracted by tech stocks and digital assets. It's almost like the same movie playing again. When the West sells, the East accumulates. Meanwhile, industrial demand is hitting all-time highs. Silver isn't just a precious metal anymore. It's a strategic resource. It's essential in solar panels, electric vehicles, batteries, and even medical technology. Every one of these growing industries depends on silver. The problem is, silver is consumed in manufacturing. Once it's used, it's gone. It doesn't come back into the market easily. That means supply is getting tighter while demand is exploding. The silver mining sector can't keep up. Many of the world's largest silver mines are producing less each year, and new discoveries are becoming rare. So you've got shrinking supply, rising industrial demand, and massive paper short positions keeping prices artificially low. That's a setup for one thing: a short squeeze of historic proportions. Imagine what happens when investors start realizing there's not enough physical silver to cover all those paper contracts. Once the first few large players demand delivery and the COMEX can't meet it without scrambling, panic will spread fast. Prices could spike violently, not because of speculation, but because of sheer scarcity. And here's the part that most people overlook. Central banks have been quietly repositioning too. For decades, silver wasn't seen as a monetary metal by most governments. But now, with gold reserves increasing globally and fiat currencies under pressure, silver is starting to look like the next logical step. Some nations may not openly declare it yet, but silver's historical role as money never disappeared. It was just waiting for the right moment to return. What's fascinating is how this shift in mindset aligns with major economic changes. Inflation remains sticky, debt levels are at historic highs, and faith in traditional financial systems is fading. Investors are beginning to understand that real wealth isn't found in paper promises, but in tangible assets, and silver fits that definition perfectly. When trust in fiat systems breaks down, people move toward what they can hold in their hands. The smart money already knows this. That's why they've been steadily taking delivery of physical silver while keeping the public distracted with short-term price dips. They're playing the long game. They understand that when this revaluation hits, it won't be gradual. It'll be sudden, violent, and irreversible. History shows that silver tends to move explosively after long periods of suppression. When it breaks free, it doesn't creep higher. It surges. Right now, all the signs are pointing in that direction. The outflows, the industrial strain, the tightening supply, it's all building pressure beneath the surface. Most investors won't notice until it's too late. But those who understand what's happening can prepare early, quietly accumulating, before the rest of the market wakes up. As we move deeper into this unfolding story, it's important to understand how real silver investors are preparing for what's coming. The key difference between those who survive and those who thrive in a revaluation isn't luck, it's positioning. Serious silver investors aren't chasing every price move or reacting emotionally to market noise. They're building quiet, strategic positions in physical metal, not paper promises. They understand that when the system eventually resets, only the ounces in your hand will matter, not the numbers on a screen. Physical ownership gives you control outside the financial system. When you hold real silver, it's yours. There's no counterparty risk, no middleman who can default, and no paper contract that can be printed into oblivion. That's why, even while the mainstream narrative continues to push ETFs and futures contracts, smart investors are steadily withdrawing physical silver from circulation. Every coin and bar taken off the market tightens supply further, bringing us one step closer to a genuine price discovery moment. But let's be clear, physical accumulation isn't about panic buying or trying to time the next big move. It's about understanding where value is migrating. Fiat currencies are losing purchasing power faster than ever before, and debt-based economies are becoming unsustainable. Central banks can print money, but they can't print silver. That's why the people who quietly accumulate over time, when prices are suppressed, are setting themselves up for massive advantage when the paper market finally breaks. Meanwhile, on the institutional side, there's another trend happening. Hedge funds, mining companies, and even some wealth managers are beginning to diversify into physical silver or silver-backed assets they can verify. It's still under the radar, but the shift is real. When these players move, they don't make loud announcements. They act quietly and systematically. And by the time retail investors notice, most of the available physical supply will already be spoken for. You can already see hints of this in the premiums. Over the past year, the gap between spot prices and the cost of real physical silver has widened dramatically. That's the market's way of telling you something's not right. The official price doesn't reflect true availability anymore. When a system shows that kind of distortion, it's a sign of deeper structural stress, just like cracks in a dam before it bursts. For long-term holders, patience is the ultimate weapon. There's a saying among seasoned stackers: you don't buy silver to get rich fast, you buy it so you don't get poor slow. It's protection, not speculation. But the irony is that protection can easily turn into opportunity when the revaluation comes. Once paper contracts lose credibility and real silver is in short supply, prices will have to adjust sharply to attract new sellers. That's when the wealth transfer begins, from those holding paper to those holding physical. Another aspect of smart positioning is understanding liquidity. Not all silver investments are equal. Coins and small bars offer flexibility for trade or quick sales, while larger bars are more efficient for storing bulk wealth. Experienced investors often keep a mix, some for liquidity, some for long-term preservation. The goal isn't just to own silver, it's to own it wisely. We're now at a stage where every suppressed price movement feels like an opportunity, not a setback. Every dip allows the patient investor to add a little more at discounted levels. It's almost poetic. The same forces that try to suppress silver are actually giving disciplined investors the best entry points they'll ever get. And when that pressure finally releases, the rewards will go to those who stayed focused while everyone else doubted. We've now reached the point where everything starts to come together. The signs are clear, the cracks in the system are growing, the physical market is tightening, and confidence in paper assets is fading. For years, silver has been underestimated, manipulated, and overlooked. But that's exactly what creates opportunity. When a market has been held down for this long, the release that follows is never small. It's powerful, fast, and life-changing for those who were paying attention early. The coming revaluation of silver won't just be about price. It will be about trust. People are slowly realizing that the entire financial structure around them is built on promises that can be broken. When fiat currencies lose credibility and debt spirals out of control, investors always return to the same place: real, tangible value. And silver, just like gold, represents honesty in a dishonest system. It can't be printed, it can't be faked for long, and it always finds its real worth sooner or later. History tells the same story every time. Whether it was after the inflation of the 1970s or the crisis of 2008, silver eventually catches up to the money printing. It may sleep for years, but when it wakes up, it runs. This time, though, the setup is different. The world has never been more digital, more indebted, or more disconnected from real value. That's why when silver finally breaks free, it won't just be another bull run, it'll be a rebalancing of wealth itself. Those who understand this aren't waiting for headlines or price targets. They're acting quietly, stacking steadily, and preparing mentally, because they know that once the crowd realizes what's happening, it'll already be too late. You won't be able to buy physical silver easily, and if you can, it'll come with massive premiums. The shelves will be empty before the news even catches up. So, as we close this series, remember this: price is temporary, value is permanent. The system can play its games for only so long before reality takes over. Silver's moment is coming, and when it does, the world will once again remember why it was called the people's metal. Thank you all for joining me on this deep dive. I hope this breakdown gave you a clearer picture of what's really happening beneath the surface. If you found value in this analysis, make sure to like, share, and subscribe to the channel. It helps more than you think and keeps this kind of research going strong. This is Gold Rush Reporter, and I'm your silver analyst, reminding you to stay sharp, stay informed, and as always, keep stacking. Until next time, take care, and I'll catch you in the next one.